Global markets hit record highs late last week as the US-China trade agreement and the passage of the Brexit bill added to positive risk sentiment. However, this optimism is being challenged by the spread of the coronavirus from China. The timing of the outbreak is very damaging as the Lunar New Year holidays begin Friday. China has placed travel restrictions on at least 3 big cities that have been hit by this fast-spreading and deadly virus. In Wuhan, where the virus apparently originated, all public transport was shut as of Thursday, and several other cities in China have followed suit. As the number of foreign cases rise, passengers on flights from Wuhan, a city of 11 million people, are facing increasing scrutiny. While the World Health Organization stopped short of calling this outbreak an international emergency, it did declare that it may yet become one. The coronavirus has unleashed memories of the SARS outbreak seen during 2003, which saw 8,000 people worldwide become sick, and of those, 774 deaths across 37 countries. SARS hammered the already weak Chinese economy at the time, dragging down growth across Asia. Stock markets across Asia have thus been under pressure, and the Shanghai Stock Exchange has lost 3.5% so far this week. Not surprisingly, given the travel bans announced in China, crude oil markets have borne the brunt of global sell pressure. West Texas, the US benchmark, is down 15% from the highs seen earlier this month after US-Iran tensions saw it hit 9-month highs. Industrial metals such as copper have been hit hard too. Last week, copper hit 8-month highs above $6,300 per ton. Last night, we traded below $6,000 a ton, down 5.6% from last week's highs. The Aussie dollar has dropped to a 5-week low of 68.27 on jitters over the impact of the Wuhan virus on Wednesday, and that's despite domestic economic data having been more positive. While consumer sentiment declined by 1.8% in December, it would have been entirely reasonable to have expected the index to have fallen further during this recent period of devastating bushfires. And after the 39,000 rise in employment seen in November, we had a whopping 29,000 rise in jobs in December reported Thursday too. More sensitive for policy is the unemployment rate, which fell to 5.1%, a low back to March 2019. Now, 5.1% is still well above the 4.5% level the RBA sees as full employment, and our forecast of sub-trend GDP growth means full employment will remain elusive, keeping the RBA considering rate cuts. But pricing for a rate cut at the first RBA meeting for the year on February 4 has been wound back to 25% from more than 50% at the beginning of the week. Now, next week brings a number of key central bank meetings. The Fed will announce policy Wednesday and likely again note that the economy is in the right place with good growth momentum. With inflation muted and a US-China trade agreement in place, the Fed has little incentive to shift course, and the US dollar should benefit as a result. Bank of England Governor Mark Carney will also hold his last press conference in this role, and it could be an important meeting. Money markets are 60% priced for a rate cut after a number of board members issued dovish comments recently. If the Bank of England does cut rates on Thursday, it will be just ahead of the UK leaving the EU on Friday night. We also have the first look at Q4 GDP in the US on Thursday, and economists are expecting a reasonably solid 2.2% outcome. Here in Australia, Q4 CPI will be important ahead of the RBA meeting and statement of monetary policy the following week. If CPI prints near expectations and fears over the coronavirus ebb over the Lunar New Year holidays, the Aussie dollar seems likely to consolidate against a firm US dollar above 68 cents. These are all factors we'll talk about in next week's Markets Update.